All right.
All right, here we are today going through loan estimate. This is the most common form that you'll see early in the loan process. And here at Mortgage by the Numbers, we get lots of local lender flavors, one of which isn't so local, Jeff Register in Florida. Say hello, Jeff.
What's going on, guys?
All right, so a loan estimate, we've chosen the standard CFPB version. So this is straight out of Consumer Finance Protection Bureau website. And without further ado, let's hop in, shall we?
Yeah, I'm going to give you control, Austin.
Sounds good. All right. So starting at the top, it's always good to check the date, the applicant name, the spelling of your name, the subject property address, purchase price, always important. Make sure all that matches what's on your contract. And if this is a refinance, of course, then that is just gonna be blank. Hopping down, we get into loan amount, interest rate, monthly principal and interest. These are details that are important, but really what I like to look at is, can the amount increase after closing? Most loans that are done these days, this video is being recorded in 2023, there aren't a whole lot of loans that will say yes here, except for interest rate. There's some adjustable rate mortgages, but no negative amortization, that kind of stuff's gone. Moving on down, Jeff, you want to hop in, go through prepayment penalty, balloon payments?
Yeah, so where are we at? We're down at the projected payments.
Not quite yet. We're just above that. Prepayment penalty.
Okay, I see it. I got you.
Yeah.
So basically it's asking if this loan that you're applying for, does it have any of these features, right? So a prepayment penalty. And so for instance, on this one, it says yes, it does have a prepayment penalty, and it's going to tell you how much it could be, and if you pay the loan off, and when you paid the loan off, how much it could be. This, even though this is on this form from the CFPB, this is atypical. Almost all of your conventional mortgages, most of the mortgages that are out there are not going to have a prepayment penalty. And in the kind of the same thing below that with a balloon payment, this one says no. And if you're not familiar with a balloon payment is essentially, if you were to get a 30-year mortgage, so your payment's going to be amortized over 30 years as if you were making this payment over the period of 30 years. But that balloon payment would have a term on there, say 5 years or 10 years. So for example, let's say it was 5 years. A balloon payment is kind of what it sounds like. Basically, even though it's been amortized over 30 years, in 5 years, that entire amount that's remaining is due. So that would be your balloon payment. And so obviously, if you had a balloon payment, you would either be paying it off or trying to refinance in order to get out of that mortgage.
So I'll hop into projected payments quickly. So this looks like it is a what do we got? I'm still scrolling. 30-year fixed rate loan with some PMI. So I'm still scrolling. Sorry for the lag. So years 1 through 7, this payment has a principal and interest plus mortgage insurance and escrow estimated payment of $1,050. And then after year 7, looks like that monthly PMI of $82 drops off, bringing down the total estimated payment to $968. Also to include in there is $206, which is for your property taxes and your homeowner's insurance. So in this loan, both are included in the escrow account. And moving on down to the...
So right where it says other, that would be something like an HOA that's not going to be collected as part of your payment. That would be, it'd be marked and it would say in escrow, and then below those 2 yeses, it would say no, that it's not part of your payment. So anything additional that is, part of your, you're not part of your mortgage, but actually part of what it costs for you to live in the home, like an HOA.
Moving on down, this gives just a synopsis of what the page 2 is going to get into detail about. So your estimated total closing cost, this scenario is $8,054, which includes partial loan costs and partial other costs. Again, we'll dive into that further next page. This is a very common question, very important number, very, very bottom, estimated cash close, $16,054. So moving on down to page 2, Jeff, how about I do left column, you do right column? Is that cool? All right. So on page 2 really gets into the nuts and bolts of this estimate. And it's categorized into sections A through J. So left column is going to be your loan specific costs. It's kind of how I like to look at it. So section A, these are specific to the lender you're working with, has these fees. They're not in any way, well, sometimes they could be negotiable, but once they've been disclosed, they cannot go up. So that's important to know as a consumer. You are protected by this. So in this scenario, that total 1802, this is where your underwriting fee is going to be your kind of in-house, the costs that go directly to the lender that you're working with. Then down in section B, these are costs that are required through the lender that you're working with, but they don't necessarily go directly to your lender. So be kind of like a credit report company or an appraiser company. So they're costs that your lender requires again, but don't go to your lender. And then down section C, these are again costs that are associated with the loan, but the lender has no control over what those actual amounts can be. For instance, title and closing attorney in the state of North Carolina. So title costs are always variable, and you, the consumer, have the ability to shop for those. And lender does the best they can to look at market averages and estimate what that total is going to be. So in this scenario, the total of sections A, B, and C is 5672. And then we move over to the other column. Jeff, what do you call these? So I like call it ABC is lender kind of specific costs. Other side is what?
Well, these are going to be, well, yeah. So A is a lender cost. There, B and C are things. There's some lender cost in B, like an appraisal and stuff like that. It's even though it's a third party. But when you get to this section over here, these are kind of fees that are kind of collected by a third party. So let's go up to E. E says taxes and other government fees. So in this particular example, you've only got $85, right? And that's a recording fee. So that's just a recording fee for them to record your mortgage. Depending on the state that you're in, those fees can vary greatly. Austin's in North Carolina. I don't believe you guys have any transfer tax or tax stamps or anything like that, do you?
We do have transfer taxes. They're usually paid for by the seller, but
okay, so you do have some. Okay. In Florida, yep, we have some tax stamps, transfer taxes. Partially, some of those are paid by the seller, and then we have an intangible tax as well, but that's going to be paid for by the buyer. So you may see some other fees in here. So this is not really comprehensive in E. You could have something that says transfer tax, tax stamps, intangible tax, things like that. That is kind of a state per state thing. And then hopping down to F is prepaids. A lot of questions come up on prepaids and below that G about escrow. So your prepaids, for instance, this says homeowners insurance premium is 6 months and they're collecting $605. So basically, when you close on the purchase of a new home, you're required to pay your homeowners insurance up front, at least for if like they're collecting 6 months. Like in my state in Florida, they collect a year because maybe this insurance company collects every 6 months. Everyone down here mostly collects a year at a time. So you're going to pay that insurance policy up front. And then below that, you're going to see prepaid interest. That's just based on the day that you're closing. Average it's usually going to see in there is 15 days halfway through the month. So if you do close on the 15th of the month, it's just going to take the days from the 15th all the way up to the 1st of the next month and calculate what that per diem interest is, where you see that 1744 times 15, and that's going to give you the 262. And then hopping on down to G, this is your escrow. So if you've chosen to escrow, which means your taxes and your insurance are going to be collected as part of your mortgage payment, they're going to need to collect some upfront to go ahead and fund that escrow account. And typically, you're going to have like 2 to 3 months of insurance that are going to be collected, and then you're going to have your property taxes. And the amount of property taxes that are going to be collected is going to depend on the time of year in which you close, because property taxes are due at different times for different counties and different states. So that can kind of change a little bit. And then down below that, you've got H, which is other. They only have owner's title insurance in here. So going back to where Austin pointed out in C, there was some title fees. There was a lender's title policy, which is also an owner's title policy. And what those things are, that's a whole nother conversation and video. But the owner's policy gets collected in H. And there's some other items that could also be collected in H. Sometimes you can see a survey in there, or a few other things. So just because in this example, we see H has only got titles, owner's title policy, don't think that that's the only thing that can be collected in there. There could be some other items as well. And then just dropping below that, it's just going to give you the total. So you got E, F, G, and H equal 2382. And then it's going to take below that, J is going to take and add everything together, right? So the D that Austin talked about over there of A, B, and C. So they're just using these letters, adding everything up and showing you that like your total closing cost and prepaids are going to equal $8,054. And then below that, you see lender credits. And the only thing I would say about that is you would look right there to see if you're getting any kind of credit from the lender. And then that can help offset some of the lender costs that you may see. So if you look up in section A, Austin pointed out, those are the only lender fees. When you're shopping for a mortgage and you're trying to compare loan estimates, these are the two things you want to compare. You want to compare A, right, which is your lender fees. And then you want to look down at lender credits and see if you're getting anything. So you could subtract the lender credits from what the total of section A is, and then use that to compare lenders, because all the other sections are going to be the same no matter what lender that you choose to use.
That's exactly right. Yeah. So, and all these numbers come together to, among many things, tell you what your bottom line cash to close is going to be. What I was going to say is determine your APR, which is further down. We get into some other cost comparison stuff. APR is a common figure that is focused on in the finance industry that's supposed to tell you kind of what the effective cost of your loan is going to be over the term. So in this case, that 30-year loan has an APR 4.724%. Actual note rate, the interest rate in this scenario, which clearly was put together in a low interest rate period
in the last year.
Yep, 3.875 interest rate with, again, so APR is always going to be a little bit higher in most cases than the note rate, such as the case here. So 4.724% is the APR, effectively higher than the note rate because of those upfront closing costs that are being paid. So thank you for tuning in. Again, this was a high-level overview. There's a lot more intricate details, which we'll get into in other segments. But for now, this is your loan estimate.
All right.
All right. So how do I switch back to give you control? Show meeting controls.